Hello all, welcome you to the course on corporate laws and governance. In this video, we are going to look at the state of corporate governance in India. Let's look at what are all the major corporate governance failures that happened in India. To start with, the first corporate governance failure which we had post-liberalization was Harshad Mehta's scam. India went for liberalization, globalization and privatization in the year 1991. At that time, the stock market was very exuberant for the reason that the economy got liberalized. Many private companies started their business as such. So it was actually doing very good, even though the stock market was very exuberant. We did not have online trading. Any trading that any of the corporates or the individuals want to do, they will have to do only through the stockbrokers. So as there were no online trading existent at that particular time. Even when we look at the banks at that time, banks were not allowed to trade in the stock market. They can only deal with the government securities market. So whatever profit that they could make out of this government securities transactions, only that could be that could reflect in the balance sheet as such. So that was one of the challenges that the banks were facing. Even for that government security transaction which they had between themselves as such, they cannot do it on their own. They can carry out these transactions only through the stockbrokers. So they were dependent on the stockbrokers in order to sell as well as buy the government securities among the banks. So in this particular scenario, Harshad Mehta, one of the stockbroker, he used it to his advantage. He made huge profits by involving in two types of scams. One was the ready forward deal, another was the fake bank receipts. What is this ready forward deal all about? If you look at this ready forward deal, we have the buying bank as well as the selling banks. The bank that would be selling the government security, and some of the banks would be buying the government securities, and the difference between the price or the interest becomes the profit. So here under the ready forward deal, whenever the buyer bank wanted to buy any kind of government security, what they normally did was they gave the money to the stockbroker to execute the transaction of buying the securities, government securities from the other banks. So what Harshad Mehta did was, Harshad Mehta got the money from these banks. Instead of using it for purchasing the government securities from other banks, he diverted this particular money into the stock market, which he was not supposed to do because banks were not allowed to transact in the stock market. He diverted the money into the stock market and he was rigging the price, especially he was rigging the price of ACC. He was creating an artificial demand for certain securities, and once the artificial increase in the price of the stock of certain stocks happened, which he himself made it happen, he used to sell those shares at a very high price, and he was making huge profit. The thing is that this particular profit was shared with the banks. Banks were aware of the fact that Harshad Mehta was diverting the funds that was given to him for transacting in government securities into the stock market, and a portion of the profit was taken by Harshad Mehta and the rest was given to the banks. So this was one of the scams that happened under the ready forward deal. What is this fake bank receipt? We do have the selling banks. So the banks would be selling the government securities through the stock brokers to the to other banks. So here what these banks did was, they did not even have the government securities, and the tradition was that whenever the deals were executed, there were no immediate transfer of the government securities from the selling bank to the buying bank. What the selling bank used to do was, like, the selling bank will issue a bank receipt to the buying bank stating that the transaction has been executed, and it is a proof that the government securities would be transferred at a later date. So here the banks did not, the selling banks did not even have the government securities. Without even having the government securities, they were issuing fake bank receipts to the buying banks. So buying banks were under the impression that actually transaction has happened, but instead the money was, whatever money that was given by the buying bank was getting diverted to the stock market. So the scam was happening at two levels, from the buying bank side as well as from the selling bank side, in collusion with the stockbroker Harshad Mehta. So this particular scam resulted in wiping off nearly 4,225 crore rupees in the financial system. This was the scam of first kind, where the government and the regulatory authorities could understand how vulnerable the financial system was. So they could, so they had to work on. So they could understand that the modifications or for that matter amendments were needed with respect to the stock market rules as well as with respect to the Companies Act. So this was a wake-up call to the government and to the regulatory authority in strengthening the financial system by bringing out changes in the Companies Act as well as in the stock market regulations. The next very prominent scam that had happened under the failure of the corporate governance was Kingfisher Airlines. Kingfisher Airlines was actually started by Mr. Vijay Mallya. This was a subsidiary of the United Breweries Limited, which was owned by Mr. Vijay Mallya. This Kingfisher Airlines was started in the year 2005. When they started, it was Kingfisher Airlines, the company was giving very good service to the customer at a very, very competitive price, that the passengers were given a very good in-flight experience. They were given exquisite cuisine, and they were having a very good experience while they were traveling, and all these were given at a very, very competitive price. But the sad part was that the company was actually not making profit. The company was in loss. In the year 2007, though the company was in loss, the company, Mr. Vijay Mallya decided to expand the company by acquiring the Deccan Airlines, which was a low-cost airline. So he acquired that, not out of the revenue which he generated from the Kingfisher Airlines. In fact, Kingfisher Airlines was making loss, but though the airline was making loss, what Mr. Vijay Mallya did was, like, he was expanding by incurring more and more debt. He was getting loans from the banks, and he bought Deccan Airlines. Not only that, in the year 2008, what he did was, like, he got the rights for the international routes from Deccan Airlines. So expansion was happening not out of the revenue, but through the debt mode. He kept on expanding the business. At one stage, the company, he couldn't manage the company. The company was making loss. The employees were not paid the salary, and the company could not pay the lease rentals for the airlines, and the company could not pay for the fuel charges. All these problems got mounted up, and in the year 2012, State Bank of India made a decision that the whatever debt that the banks, the consortium of banks had with Kingfisher Airlines, it was declared as non-performing assets. And one stage, Vijay Mallya couldn't manage it, and he fled the country. So this was a corporate governance failure, which shook the entire country. So let's assume let's look at what are all the major corporate governance failures that had happened in the Kingfisher Airlines. One was that the board of directors did not play their role correctly, because we all know that board of directors should play a fiduciary role. They will have to play they will have to have a due diligence in whatever decisions that the company takes. But what the board of directors did was they did not play their role properly. They did not advise the company in going in the right direction. Whatever strategic decisions that were made by the company, it was all faulty. But the board of directors did not pitch in, and they did not advise, and they did not put the company in the right direction. So as such, they failed in their duty. The next failure, corporate governance failure, which we can notice is that the auditors actually they were flagging that the company was not following the accounting standards in the preparation of their financial statements. So this particular problem was raised by the auditors, but no one listened to the objections that were raised by the auditors. This again, one of the reason for the corporate governance failure in Kingfisher Airlines. The next reason is that at that particular time, the chief executive officer of Kingfisher Airlines was paid a very exorbitant amount as the salary, which was very, very high in comparison with his counterparts in other airlines. So it was not regulated at all. The compensation that was paid to the senior level was not regulated at all. So this was also one of the reasons for the corporate governance failure. Next, let's look at the Satyam scam. Satyam Computers started in the year 1987 by Mr. Ramalinga Raju. Actually, in the year 2008, it was considered, Satyam Computers was considered as the second largest business process outsourcing company in India. But if you look at it, all kinds of nasty things started happening in the year 2001 itself, but it came to light only in the year 2009. The World Bank actually in fact stopped Satyam Computers in dealing with any of the projects of the World Bank because of the data theft which they got into, as well as the bribes that they paid to the employees of the World Bank. All that resulted in the punishment by the World Bank, stating that they will never deal with Satyam Computers. So the downfall of the Satyam Computers came to light only in the year 2009, even though things were started going wrong from 2001 or 2 onwards. If you look at what are all the failures that had happened in the Satyam scam, was that Mr. Ramalinga Raju was having the excessive power. In the sense, he was only handling all the accounts of the company. So he was actually fudging the accounts. He used to have 2 accounts under the single bank. He will not give the genuine accounting statement to the company for the preparation of the financial statement. Instead, he will fudge the accounting statement. He will give a false accounting statement wherein the fixed deposits, the cash balance in the bank, all that were fudged, and it was given to the company for the preparation of the financial statements. And not only that, he also involved in preparing fake invoices in the name of genuine clients, and all the invoices had overstated amount. That means he was giving an impression that the business is actually doing so good, and which was actually not the case. Not only that, he created nearly 350 shell companies, and he was diverting the money from Satyam Computers to these shell companies, which he actually used it for his own interest. So, fixed deposits were all fake, and whatever accounts that was prepared by the company, it was all fudged, overstated amount. It all gave a very wrong impression to the shareholders, giving an impression that the company actually is doing good, which was really not the case. Auditors also played a very, very major role in this downfall. Auditors did not play their role properly. Auditors are expected to exhibit due diligence in their functioning. They are expected to be neutral. They have to go for the independent evaluation of the accounts. Instead, they did not go verify any of the documents that were submitted by Mr. Ramalinga Raju. They did not make an even effort to check whether the informations that were furnished by Mr. Ramalinga Raju was genuine. So it was not, they did not play their role correctly. Not only that, these auditors were paid a very high fee for their work. And again, Ramalinga Raju was having all the powers with him. So excessive power in one hand always creates problem. So he started misusing the excessive power which he was having, and the board of directors, of course, they did not have a check on the role that was played by Mr. Ramalinga Raju. So it was all unbridled, and he involved in himself with all the unethical conduct, like creating the shell companies, 350 shell companies, diverting the profit of Satyam Computers to these shell companies and using it for his own interest. So all unethical conduct had happened, which had resulted in the major corporate governance failure in Satyam Computers. Next, let's look at what are all the common governance problem that we have noticed in all these corporate governance failures, which we have looked at, like Harshad Mehta scam, or for that matter Kingfisher Airlines or Satyam Computers. So let's sum up what are all the major failures that had happened in these companies. One was that auditors did not play their role correctly. They did not play a neutral role. They did not use their due diligence. They did not play their fiduciary role correctly. So somewhere down the line, the downfall of these companies were because of the failure in the performance of the duties by the auditors. So that is one of the major reasons. Another reason was that somewhere down the line there were lack of independent directors in the board. When these directors are going to have a material relationship with the promoters of the company, there are chances that they will be hand in glove with these directors, as such with the promoters, and which they allowed the promoters to use these resources of the company for their own interest. Instead, what they should have done is they should have kept the interest of the shareholders in mind while taking any decisions. So these decision making became very ineffective, mainly because of this related party transactions, because of lack of independence of the board of directors. All these were the reasons for the failure. Next was to do with the insider trading. The inside informations were given to the stockbrokers. Somewhere down the line collusion happened between the intermediaries and the company. So that was also one of the reasons for the corporate governance failure. And they did not have check on the remuneration that would be paid to the board of directors, executive directors, non-executive directors, senior management, that is the management which is just one level below the board, like the chief financial officer, chief executive officer. All these fixation of the compensation was all unbridled. It was not in control at all. So that was also one of the reasons for the corporate governance failure. The next is that somewhere down the line, the board of directors forget about the directors not being independent, but as the member of the board, a director is expected to play a fiduciary role where they will have to be diligent in while checking the transactions, and they will have to be proactive, and they will have to ensure that the company moves in the right direction. So these board of directors, whether being independent or not independent, they did not play their role correctly. They did not pitch in when the company was actually not going in the right directions. So these were all the major reasons for the corporate governance failure. Okay. Again, one more thing is that the weak internal control mechanism. and the lack of supervision. So somewhere down the line, risk management matters a lot. The company, the executives should have a very good risk management mechanism wherein they should identify what are all the major risks that the company faces and what are all the ways that they are going to overcome it and what are the challenges that they have in it. So there should be a proper risk management mechanism and the internal control mechanism, which never happened in all these companies. So let's see what and all had happened because of all these scams and the corporate governance failure. What are all the major changes that happened in the Companies Act 2013? One was the Companies Act 2013 made it mandatory that there should be independent directors. Section 149 subsection 4 read with Rule 4 of Companies Appointment and Qualification of Directors Rules 2014 clearly states that any public company or any listed company with a paid up capital of 10 crores or more or a turnover of rupees 100 crores or more should have at least 2 independent directors in the board. And they are also talking about they have also given a very clear definition with respect to how the independence is defined. So they have come out with the list of characteristics that the director should possess in order to term themselves as independent in true sense. So they are also telling that they have also made it mandatory that these independent directors should give the declaration in front of the board at every board meetings during the every financial year. They will have to declare that they are independent. In case there are going to be any compromise with respect to their independence, this should be flagged by the independent director in the board meetings. So this independent director, appointment of independent directors will definitely bring down the number of failures that happens in the company. The next important addition or amendment that had happened in the Companies Act is the appointment of the Audit Committee. Section 177 of the Companies Act 2013, Rule 6 and 7 of the Companies Meetings of Board and its Powers Rules 2014 states that any listed company or a public company with a turnover of rupees 100 crore or a paid capital of rupees 10 crore should definitely have an audit committee. If you look at it, audit committee should be headed by the non-executive director. It should comprise more of non-executive directors. And it also says this audit committee plays a very crucial role with respect to the internal control mechanism, risk management, with respect to the auditing of the company. They are responsible in checking the strategic plan of the company. So these are all the varied roles that are played by this audit committee, so that they will ensure that there is proper internal and external audit happening in the company. They will ensure that there is proper internal control mechanism and the risk management mechanism in the company, and they will also ensure that the company goes in the right direction, because they are going to check whether the strategic plans are in place, whether that requires any kind of change. All the budgets, plans and programs would be actually supervised by these audit committees. So this was also one of the initiatives that, or one of the change that had been brought in the Companies Act in order to avoid the corporate governance failure. The next is the Serious Fraud Investigation Office. The setting up of the Serious Fraud Investigation Office is dealt by Section 211 subsection 1 of the Companies Act 2013. Under this, what this states is that whenever there is going to be any kind of fraud that is getting detected in any company, the Serious Fraud Investigation Office would be set up, either on based on the report that are submitted by the registrar of the company, or based on the report of the inspector, or for the public interest, or if any of the department of the central government or the state government feels that Serious Fraud Investigation Office has to be set up, then it would be set up in order to investigate the fraudulent activities that happens in a company. the next important change that has happened in the Companies Act with respect to corporate governance is the corporate social responsibility. Section 135 and Schedule 7 of the Companies Act deals with this corporate social responsibility. Now, corporate social responsibility is mandatory for the companies which has a paid up capital of say rupees 500 crores, which has a turnover of rupees 1000 crores, or which has a profit of rupees 5 crores, then it is mandatory that they have to contribute 2% of their net profit, average net profit of the preceding 3 years towards the corporate social responsibility. So now every company has to give back to the society from which they are actually thriving. So these are all the major changes that has happened in the Companies Act, which helps in strengthening the corporate governance among the companies. Now let's look at what are all the recent trends that are there in India with respect to corporate governance. And let me first tell what are all the recent trends that has happened with respect to corporate governance in India. The first one is the business responsibility and sustainability reporting by listed companies. Second is the board diversity. Third one is the physical verification of office. And the fourth one is the decriminalization of offences. First, let's look at the business responsibility and sustainability reporting. If we look at the global scenario, investors are actually giving more importance to the sustainability investing. They are actually looking for investment funds which focuses on the sustainability, and they invest more and more in sustainability funds. And if we look at it, the investment in the sustainability funds by the global investors has increased by 129% from 2018 to 2020. So people are actually giving more importance to sustainability investing, and this has actually become more and more post the pandemic. After the COVID-19, people are giving more importance to the protection of the environment, and as well as they are more bothered about sustainability. If we look at United Kingdom, they are actually they have actually made it mandatory that the premium listed companies should go for climate change reporting. If we look at European Union's ESG reporting, that is the environment, social and governance reporting, has been made mandatory for any company which has the employee size of 500 or more. Then it is mandatory that these companies should report about their ESG activities, that is the environment, social and the governance activities. Similarly, if we look at Hong Kong, Singapore, Taiwan, sustainable reporting has become important or has become essential for the companies. So at the global level, sustainability reporting is gaining momentum. Let's look at India. Yes, if we look at India, the Securities and Exchange Board of India have made this business responsibility reporting mandatory for the top 100 listed companies in the year 2012. And what it did was that they made it in the year 2015, they made it mandatory for the top 500 companies. And if we look at it, these business responsibility reporting was based on the national voluntary guidelines on the social, economic and environmental responsibility of the business. The Ministry of Corporate Affairs came out with the national voluntary guidelines for the social, environment and economic responsibilities of business. Based on that, SEBI came out with this business responsibility reporting, which was made mandatory for the top 100 companies in the year 2012, and it was extended to the top 500 companies in the year 2015. In the year 2019, this business responsibility reporting was made mandatory for the top 1000 listed companies by SEBI. And if we look at this in 2019, they changed this business responsibility reporting into business responsibility and sustainability reporting. This business responsibility and sustainability reporting were based on the 9 principles which was given under the National Guidelines on Responsible Business by Ministry of Corporate Affairs. And this was made mandatory. This BRSR, that is Business Responsibility and Sustainability Reporting, was made mandatory for the top 1000 listed companies right from 2019. And when we look at the disclosures that happened under these 9 principles, was that it was divided into essential as well as leadership. Essential means that is mandatory, it is compulsory that the company should disclose it, and if it is leadership, then it is voluntary. It would be based on comply or explain basis. So in case they comply, they can tell that they are actually complying with all these all the 9 of all those disclosures. In case they fail to comply, they will have to give the reason why they couldn't comply with the requirements. Now let's look at what are all the key disclosures that are there in the business responsibility and sustainable reporting. First is that the companies are expected to give an overview of the risks and opportunities that are there in the ESG. ESG is environment, social and governance. So they will have to make a very clear overview of what are all the risks and opportunities that they have with respect to environment, social and governance. Let's look at what are all the environment related disclosures that the company is expected to disclose. And all these disclosures are mandatory in nature. They will have to disclose about their resource usage. When we say resource usage, they will have to talk about the composition of the renewable energy and non-renewable energy in their resource utilization. They will have to give information about their air emissions, where they will have to give details about the greenhouse effects. They will have to give information or disclose about their waste management. When we talk about the waste management, they will have to give information about both the hazardous and the non-hazardous waste management system that the company has. They will have to give the compliance with the extended producer's responsibility plan, which they have submitted to the Pollution Control Board, and performance achieved trade scheme of the Bureau of Energy Efficiency. They will have to tell the extent to which they have complied with the plans, whatever they have submitted to both the PAT, yes, as well as to the Pollution Control Board. Let's look at what are all the social related disclosures which the company has to make under this BRSR. When we talk about the social related disclosures, first is to do with the employees or worker related disclosures. Employees and worker related disclosures, they will have to talk about the gender diversity. They will have to give information about the employee diversity, in the sense that what are all the schemes or the welfare schemes that they have for the physically challenged individuals or the employees. They will have to talk about the payment or the compensation system that they have for both the permanent employees as well as the temporary employees. They will have to give details about the safety, health that they are providing to the employees. With respect to community related disclosures, they will have to give information about the social impact assessment, corporate social responsibility, rehabilitation and resettlement. They will have to give information about all these aspects. With consumer related disclosures, they will have to talk about the product labeling, product recall, product packaging, and different complaints, grievances that they have received from the consumers on the data theft. With respect to cyber security, these informations have to be divulged. Next, let's look at what are all the governance related disclosures which the company is expected to disclose under the key disclosures in the BRSR. When we look at the governance related disclosure, they will have to give information about the role of the board in sustainability, wherein the board of director has to clearly give a report on what are all the activities that they have taken towards the sustainability, what are all the challenges that they faced. These informations have to be given as a report by the board. Next is to do with the conduct related. When we talk about the conduct related, here they will have to give information about the different fines and penalties which they have to pay to the regulatory authority in case of non-compliance of any of the 9 principles that had been given by the Ministry of Corporate Affairs. So, if they have paid any fees or penalty, all these details have to be given. The next trend that we are going to look at is the board diversity. Board diversity is very, very important. If we look at it, the proportion of female population in India across the globe, it is very, very high. But when we look at their representation in the board, it is very, very limited. Somewhere down the line, board diversity or the participation of women in the board is very, very important, because they will bring in more new perspectives and they will also bring in innovation, creativity, and they will also ensure that better decisions are made. So, board diversity is very, very important, where there should be more participation by the female in the board. That's very, very important. So, let us see what are all the initiatives that had been taken by the Companies Act as well as by SEBI for the appointment of female directors. So, the second proviso to section 149 subsection 1 and rule 3 of the Companies Appointment and Qualification of Directors, Rule 2014, has made it mandatory that there should be a female director in the board if the company is going to have a turnover of 300 crores, or if the company, when I say a company, we mean the public company, a listed company. If the listed company is going to have a turnover of rupees 300 crores or more, or if they are going to have a paid up capital of rupees 100 crore or more, it is mandatory that there should be a female director in the board. So, this is the initiative that had been taken by the Companies Act. If we look at the SEBI in their listing obligation and disclosure requirement regulation 2015, they have gone a step ahead, and they have told that so there should be definitely the female directors in the company, which is mandatory. Even in the audit committee, there should be a female director presence, and this female director should be an independent director. It is not about the executive director. There should be a female independent director in all the listed companies as per Securities and Exchange Board of India's listing obligations and disclosure requirement regulation 2015. So, this is actually whatever chart that we are looking at. It is the research that was done by the EY. Ernst & Young has done this analysis, and what they have found out was that in India, right, they had looked at the different listed companies, and they have found out that the participation of women in the executive position has in fact increased from 6% in 2017 to 7.2% in 2022. So, the good point is there is participation not only in the non-executive position, in the executive position definitely women participation has increased from 6 to 7%, 7.2%. And if you look at the non-executive position, their participation has actually increased from 16% in 2017 to 21.4% in 2022. So, what we could understand was that women's participation in non-executive position is better than the executive position, but the participation has increased both in the executive position as well as in the non-executive position, which is a very good sign as such, and this could be due to the initiatives or the rules that had been taken, that had been made mandatory by both the Companies Act as well as by the SEBI. Next trend that we are going to look at with respect to corporate governance in India is the physical verification of office. Normally, the registrar of companies goes for the physical verification of office whenever in order to reduce the number of shell companies, or whenever they have a doubt that whatever information that had been submitted by the company is dubious, when they feel that it is dubious and there could be chances that it could be false. So when they feel that there are falsification of the documents, or when they feel that certain companies are shell companies, what they do, they go for the physical verification of office. Companies Incorporation, Third Amendment Rule 2022, Rule 25B talks about this physical verification of office. This physical verification of office was there it got introduced in the year 2018 itself. Again, it got amended in the year 2019. So how this third amendment 2022 is different from 2018 and 2019 was that in the previous provisions with respect to physical verification in the Companies Act, they were talking about why the physical verification had to be done, but there were no information on the process, the way in which the physical verification had to be taken up by the registrar of companies. So here the Companies Incorporation Third Amendment Rule 2022 talks about very clearly what are all the procedures that have to be followed by the registrar of companies while carrying out this physical verification of office. It is whenever the registrar of office feels that there are falsification of documents, or when they feel that a particular company does not exist or it doesn't have any business operation, which is a shell company, whenever they have a doubt, they can carry out, they have every right to carry out the physical verification of the register office of the company. When they do this physical verification, they are expected to have the two independent witness with them, and these two independent witness should belong to the locality in which the registered office of the company which is under investigation is located. So they have to take in two witnesses from the same locality when they go for physical verification of office. When they do the physical verification of office, they cross verify the authenticity of the various documents that had been submitted by the company with the registrar of companies at the time of the incorporation. So they would be checking whether it is actually true or not. In case they find out that there are malpractices and the documents are not up to the mark, and if they come to a conclusion that particular register office is not good enough to be to send the communication or to receive the communications from the registrar of companies, what they will do is they will give a notice to the company stating that the company would be removed from the register of the companies. So that would be the decision. Once the registrar of company is dissatisfied with the documents or with during the physical verification process, and once they are unhappy with the documents, and once they feel that particular office is unfit to be sent to receive any kind of communication, so they will give a notice to the company. They will have to prepare a detailed report why they feel so, and they can go with the notice for the removal of the name of the company from the register of the companies. So once the company receives the notice from the registrar of companies, they will have 30 days time to give their representation in response to the notice. So they can definitely contest it, and they will be given a period of 30 days to refute the charges. The next trend that we have with respect to corporate governance is the decriminalization of offences. The Ministry of Corporate Affairs decriminalized various offences under the Companies Amendment Act 2019 and the Companies Amendment Act 2020. And what is this decriminalization of offences? Here they were actually dividing or demarcating the offences into two. One is the compoundable offences, another is non-compoundable offences. What is this compoundable offences? Under the compoundable offences, what if the company is found to be to be to have practiced or to have involved in any kind of offences, they will have to either pay a penalty, or they will have to pay a fine, or they will have to undergo imprisonment, or they will have to undergo both fine or a penalty as well as the imprisonment, depending on the severity of the offence that they have committed. And under the compoundable offences, they also have an opportunity to pay a fee, and they can pay a fee to the compounding authority, and they can come to a compromise, or they can also arrive at a compromise with the compounding officer through the negotiation. So, compromise is possible under the compoundable offence. Either they will have to pay a fine or penalty or imprisonment, or both fine, penalty as well as imprisonment, or they can go with a compromise by either by paying a fee, or they can come to a compromise through negotiation with the compounding officer. When we look at this non-compoundable offences, they cannot come with a compromise. They have to either pay a penalty or a fine or imprisonment or both. They cannot come with a compromise with the compounding authority, either by paying a fee or by coming to a kind of settlement through negotiation. That is not possible under the non-compoundable offences. Why are we talking about these decriminalization of offences? Is that the purpose of this decriminalization of offences was that they wanted to promote the ease of doing business. Not all the offences are criminal in nature. Somewhere down the line, they will have to differentiate the offences. Some offences would be a civil liability. It will not be a criminal liability at all. So, when they are going to differentiate the civil liability from the criminal liability, so whatever, not every offence should be brought to the criminal justice system. So, when you are going to bring all the offences under the criminal justice system, what happens? The criminal justice system would be overburdened, and they will not be in a position to resolve many of the cases. So, when we are going to differentiate the offences into compoundable and non-compoundable, when we are going to differentiate the minor offences which are not criminal in nature, this is going to make the life of the company better, in the sense they need not waste their time in dealing with these cases under the criminal justice system, nor the criminal justice system have to undergo all these burden of looking into all these cases. So, somewhere down the line, both the parties would be having more time in dealing with their core activities. So, that was the idea of this decriminalization of offences. So, what they have done is they have reclassified the procedural, technical, minor non-compliances as civil liabilities, which where they can go with the compromise, they can go with settlement, where they can pay a fee, and they can come to an agreement with the other party. So, all these are off the court settlement can be done, not that everything has to be brought to the court. So, this somewhere down the line reduces the burden of the criminal justice system, and it also promotes the ease of doing business, and this also will help many foreign direct investments to happen in a country. So, thanks for listening.